Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everyone. Today is July 13, 2026. Chip rally lifts the week last week. So stocks largely advanced over a V-shaped week, lifted by a fresh burst of AI enthusiasm amid geopolitical jitters as Washington and Tehran resumed high-stakes negotiations. The S&P 500 index rose 1.23%, while the NASDAQ Composite Index advanced 1.74%. The Dow Jones Industrial Average declined 0.50%. The MSCI EAFE Index, which tracks developed overseas stock markets, lost 1.42%. Tech-led rise past geopolitical concerns. So, again, the S&P 500 ended Friday's session at 7,575.39, securing a second straight weekly advance. The gauge has gained 1% in July and is up 11% this year. AI sentiment got a boost Friday from the strong NASDAQ debut of SK Hynix. The South Korean chipmaker's American Depository shares jumped 13% to $168.40 after the offering of 177.9 million shares, ADS priced at $149 apiece. Investors were also watching developments in U.S.-Iran diplomacy. President Donald Trump said the U.S. will continue negotiations with Iran while reiterating that their ceasefire is over. Technology led sector gains for the week, rising 3.4%, followed by a 3.2% advance in energy and a 2.3% increase in communication services. Consumer discretionary and financials edged higher. Hewlett-Packard's Enterprise jumped 18% this week, and Arista Networks advanced 17% for the biggest gains in tech. Baker Hughes recorded the largest gain in the energy sector, climbing 9.1%, as the company received conditional approval from the European Commission to acquire Chart Industries. Meta Platforms shares rose 15% last week, leading communication services. CEO Mark Zuckerberg said the company is considering renting out some of its AI computing capacity, Bloomberg reported. Materials fell 2.2%, followed by a 1.9% loss in healthcare. Consumer staples dropped 1.3%, and industrials shed 1.1%, while utilities and real estate edged lower. International flavors and fragrances shares fell 7.5%, and Albemarle dropped 7%, the steepest weekly losses in materials. The quarterly earnings season is set to move into full swing this week. Reports are expected from JP Morgan Chase, Bank of America, Goldman Sachs, Wells Fargo, Citigroup, and Morgan Stanley. So the financials. The other large companies expected to report include Johnson & Johnson, United Health, GE Aerospace, Netflix, and Abbott Laboratories. All right, so weekly market insights. S&P's up nearly 11, NASDAQ's up about 13, MSCI's up about 9 to 10, and Dow is up about 10% this year. And the 10-year Treasury note's trading about 4.56%. That's up 22 basis points from a month ago at 4.55%. Thank you, Y-Charts, for that information. All right, a family fight vexed by inflation. Minutes from the Fed's June meeting were released on Wednesday and revealed a Fed divided and unsure of how to proceed without more inflation data. Fed officials offered opposing arguments at the meeting about whether to raise or lower interest rates. Fed Chair Warsh called the debate a family fight and gave little forward guidance on where the next decision was leaning, adding they would continue to assess incoming information on inflation. This week, key economic data: Monday, Treasury balance; Tuesday, NFIB Small Business Optimism Index, Consumer Price Index, and Fed Chair Warsh presents monetary policy report to Congress. Chicago Fed President Austan Goolsbee speaks. Wednesday, Producer Price Index, Personal Consumption. New York Fed President John Williams speaks in the Fed Beige Book. Thursday, retail sales, weekly jobless claims, manufacturing and trade, inventories and sales, NAHB Housing Market Index, and pending home sales. Dallas Fed President Lori Logan also speaks on Thursday. Friday, housing starts, import prices, industrial production capacity utilization, and University of Michigan survey results. Thank Investors Business Daily for that calendar. Reporting cash payments, tax tip of the week. Individuals, companies, corporations, and others must report cash transactions of more than $10,000. These cash payments can include jewelry sales, gifts from family members, overseas purchases, or any other cash transactions. You also need to report cash payments received in one lump sum, in two or more related payments within 24 hours, or as part of a single transaction or two or more transactions in the previous year. All you need to do is file a Form 8300, report of cash payments over $10,000 received in trade or business. The form requires information about the giver and the recipient of the cash, a description of the transaction, and the details about any other parties involved. This information is not a substitute for individualized tax advice. Please consult with a qualified tax professional to discuss your specific tax issues. And this tip was adapted from irs.gov. Stay tuned for the next segment. Got a good show for you. So the S&P 500 index for the year to date through May 29, 2026, the S&P 500 trended lower in the first quarter before recovering in April and May. The first half was marked by two overriding themes: the Middle East and artificial intelligence, or AI. As you look at a chart that I'll be putting out here soon, you'll see stocks went sideways for much of the first quarter and then slid in March as the Middle East conflict and the subsequent closure of the Strait of Hormuz took a toll on market sentiment. At the same time, the economy in the first quarter began to recover. The resulting oil shock from the Strait of Hormuz closure impacted the world economy, including a jump in year-over-year inflation to 3.8%, which was a three-year high due to the higher prices of oil and fuel costs. Then things hit a turning point at the end of March. Diplomatic efforts began to lift market sentiment. That, coupled with enthusiasm for AI, helped the market rebound in April and in May. We use a chart of the S&P 500 Composite Index because it's generally considered representative of the U.S. stock market. Index performance is not indicative of past performance of a particular investment, and past performance does not guarantee future results. Individuals cannot invest directly in an index, and the return in principal value of stock prices will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original cost. Thank you, Wall Street Journal, for some of that information. So I chatted a little bit about how the S&P 500 performed so far this year, but how does that performance compare to expectations? At the end of each year, the Wall Street analysts share predictions for the year ahead. This table that I'm going to post soon shows several 2026 projections for the end of 2025. How do those predictions compare to reality so far? The S&P 500 closed at 6,846 on December 31st, 2025, and at 7,580 on May 29th, 2026. So what you'll see is Deutsche Bank has a price target of 8,000 on the S&P, Morgan Stanley 7,800, RBC 7,750, Goldman Sachs 7,600, JP Morgan 7,500, and B of A, or Bank of America Global Research 7,100. The group average is about 7,825. Okay, and as of the end of May, it was the S&P 500 closed around 7,580. So let's take a look at how those Wall Street analyst predictions are holding up this year. As the chart shows, which I'll post soon, most firms are sticking with their start of the year forecasts. A few have adjusted higher and one has adjusted lower, but most are unchanged. Estimating where the S&P 500 will be by the end of the year is always challenging, especially in 2026, given the uncertainties of the Middle East, inflation, and expanding the expanding AI trade. But so far, at least, most firms are comfortable with their outlook. Wells Fargo lowered their outlook from 7,800 down to 7,300. Let's see, Yardeni Research Let's see, would they go from 7,700 up to 8,250? So they're one of the most bullish on the street. Oppenheimer, 8,100. They're maintaining their forward guidance. Deutsche Bank maintains at 8,000. Morgan Stanley increased from about 7,750 to 8,000. RBC Capital, they increased from 7,750 to 7,900. Evercore ISI kept theirs flat or unchanged. Fundstrat, 7,700. Citigroup, 7,700 maintained. Barclays, 7,650 up from 7,400. JP Morgan up to 7,600 from 7,500. Scotiabank, 7,600, and they increased a little bit. UBS kept theirs flat. Bank of America kept theirs the same at 7,100. Ned Davis, 7,100, and Stifel Nicholas, 7,000. And so far, we're trading well above a lot of the lower end ranges, kind of in the middle of where the forecasts of 2026 are at. But it's very interesting to see. We still have some further upside based on the most bullish forecasts. So we'll talk about some factors and historical trends that may impact stocks for the second half of the year. To create some context about where the economy may go in the second half, let's take a look back to June of last year so you get a better perspective on how quickly the outlook can change. We picked June 2025 because it takes us back to when tariff negotiations were in full swing. A year ago, the majority of economic and financial indicators, 16 out of 20, were neutral. Only credit availability and fiscal policy were positive sentiments, while valuation and outlook and geopolitical risk were the two only negative indicators. Just 6 months later, the economic outlook had begun to improve across many of the financial indicators that we track, as investors seemed to put the short-term economic impact of tariffs behind them. The number of positive indicators increased to 6, with 4 changing from yellow to green and only 1 remaining negative, equity market valuation, as geopolitical risk improved from red to yellow. Okay, so I'll post a source out there for you guys to check that out. So be looking for that here soon. Fast forward another 6 months to June 2026, and a lot of the economic indicators are telling a more cautionary tale. The number of positive or green indicators dropped from 6 to 2 so far this year, and 18 indicators are showing a neutral stance compared with 16 a year ago. The takeaway here is that indicators can change quickly. The other takeaway is remember the old saying, stocks climb a wall of worry. So it doesn't necessarily mean that the future is going to be necessarily negative. Having some healthy skepticism in the markets is a good thing. If it were too complacent, where people were just not even thinking about the risks, the market would be in a bubble situation or overextended situation meant for consolidation at some point in the near term. So far, we're climbing that wall of worry and things look relatively constructive. Corporate earnings, one driver of stock prices. So I've got a good chart on this. Changes in the S&P 500 performance in the 12-month forward earnings per share or EPS. I'll post this chart out there soon for those of you listening. The chart shows the relationship between changes in the S&P 500 Composite Index and the 12-month forward earnings per share, EPS. As you can see, the two lines have generally moved in the same direction over the past decade. Because the stock market is a discounting mechanism reflecting what investors believe the economy will look like in 6 to 9 months in the future, stock prices can at times change more quickly than earnings growth. So that is an indication, but the market is trending up and to the right. Everybody likes that. And corrections are normal parts of markets. So be aware of that. All right, inflation by the numbers. So year over year inflation versus month over month inflation rates. They've ticked up in recent months. When determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold its monetary policy goals, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps it determine whether to adjust interest rates. The Fed has stated that it's comfortable with inflation in the 2% range. We're looking at two charts here. One depicts the pace of consumer price inflation on a year-over-year basis, and the other shows month-to-month or month-over-month inflation. As you can see in the chart, year-over-year inflation trended higher in March and April, and as higher oil prices from the Middle East conflict rippled through the global economy, which we anticipated and talked about on this podcast many months ago when this was happening. Month over month, it was a similar story. As we get deeper into 2026, we'll start to see if the March CPI report was an outlier or if it's going to be around a little bit stickier. Expect the Fed's decision on monetary policy to continue to influence financial markets through the second half of the year as more clarity emerges on the Middle East conflict's impact on inflation. Thank you, Trading Economics, for that information. And let's take a look at labor. So the labor market continues to demonstrate its resilience. This vitality has provided an important support to the market since having a job is foundational to consumer spending, which has historically driven about 2/3 of U.S. economic growth. This strength may be best illustrated by the two labor market measures, current job openings and the unemployment rate. While the number of job openings has fallen since its post-COVID peak, the percentage of companies unable to fill open positions remains elevated compared to the 2016 to 2020 period and has been trending up so far in 2026. The unemployment rate, meanwhile, continues to remain at historically low levels thanks to continued private sector hiring. These two are just two indicators economists use when measuring the health of the labor market: St. Louis Fed data and Trading Economics. Oil chatter, oil price mentions on quarterly conference calls. So, while the market pundits and others may talk frequently about oil prices, CEOs don't necessarily discuss the price of oil on quarterly earnings calls, but it's come up more and more in shareholder conversations since the start of the year. On quarterly calls with shareholders, the phrase oil prices was mentioned by CEOs 149 times in the first quarter of 2026. That's a 176% increase compared to the fourth quarter of 2025, when it was mentioned only 54 times. Investors want to hear how oil prices are affecting the global economy, inflation, and companies specifically, and how those companies are adapting their business strategies accordingly. Thank you, FactSet, for that information as of May. So where are we now? Here's some potential headlines. Let's take a moment to consider the issues that may weigh heaviest on market performance during the second half of 2026. The first is the Middle East, which has impacted large sections of the economy, both here at home and around the world. If peace talks succeed, this is one headline you may see if all parties agree to reopen the Strait of Hormuz, which leads us to the next potential headline. Even if a peace agreement comes quickly to the Middle East, inflation will remain a threat to the economy despite the Federal Reserve's best efforts to contain it. If the Fed does adjust rates, the change is likely to have a ripple effect throughout the economy. And finally, artificial intelligence may once again drive headlines, especially if it moves into a new phase. Of course, no one can predict what will happen in the future, but we hope the following perspectives help you understand what we believe may be on the horizon. Finally, let's take a look at potential forecasts for the second half of the year and beyond. So let's take a look at what market strategists think about the direction of the stock market over the next few quarters. Some market strategists look at the bottoms up earnings per share to help set their price target for the S&P 500 index. When setting a bottoms-up EPS, strategists focus their attention on estimating earnings for all S&P 500 companies. By contrast, a top-down investing target price places a greater emphasis on macroeconomic factors when making an investment forecast. So the chart that I'm going to put out there soon, it shows the price of the S&P 500 and the bottom-up EPS. Notice how stock prices have been trending higher at a steeper pace compared with corporate earnings over the past 3 months. This type of analysis shouldn't be seen as a perfect predictor of our stock price performance. When evaluating this chart, when you guys see it, it's important to remember that the stock market's considered a discounting mechanism, which means that it's always looking forward. Put another way, the stock market's price today represents all available information about current and future events. How far forward is the stock market looking? Most would agree it's discounting activity 6 to 9 months into the future. So, stock prices seeing a turnaround in earnings, that's uncertain and only time will tell. Here are a few things to keep in mind. Past performance doesn't guarantee future results, and individuals can invest in an index. So, FYI on that. So, how much will corporate earnings grow? Considering the importance of corporate earnings to stock valuations, the big question for investors is, what can we expect for future corporate earnings? If you take a look at this chart, that's the S&P 500 projected earnings growth for the second quarter of 2026 year over year by sector. You'll notice that earnings for 5 out of the 11 industry sectors of the S&P 500 are expected to grow at a faster clip over year in the second quarter than they did in the first quarter. Fourth from the bottom left on this chart is the overall year-over-year second quarter earnings growth projection for all S&P 500 companies. Some sectors are expected to do better while others are projected to lag. Earnings growth projections are slightly higher for all of 2026, with analysts projecting 22.1% growth for the entire calendar year. Thank you, FactSet Research Earnings Insight, for that data. To gain a better insight into how economists think the economy will perform, we'll take a look at the May 2026 survey of professional forecasters conducted by the Federal Reserve of Philadelphia. Let's look specifically at the consensus forecast for the 3 key economic factors that may influence the market's perception of the state of the economy. So we take a look at GDP growth, unemployment, and inflation. As you can see in this particular chart, which I'll put out there again, the consensus view as of May 2026 is that GDP growth is expected to be between 1.5% and 2.4% in 2026. Meanwhile, professionals are projecting that the unemployment rate will be between 4.3% and 4.8%. These professionals also expect inflation as measured by the core personal consumption expenditures to be between 3% and 3.4%, up a bracket from last year. Okay, and remember, forecasts are based on assumptions and subject to revisions over time. Source is the Federal Reserve of Philadelphia as of May. All right, how long will inflation stick around? Sticky price, the CPI. Future progress on managing inflation may be a bit more difficult. One aspect of inflation is what we called sticky inflation. Sticky inflation refers to the components of the consumer price index that have historically exhibited a greater rigidity or stickiness with respect to price changes. Sticky inflation includes many service-based categories, including medical services, education, and personal care services, as well as most of the housing categories. In recent years, the Federal Reserve has commented on stickiness and service-related inflation as one reason for remaining vigilant in its fight to lower inflation. As you can see in what I'm going to put out there in this chart, while the Atlanta Fed's measure of sticky inflation has been stubborn, it has moderated over the past 2 to 3 years and moved closer to flexible CPI. Needless to say, the Fed has much to consider as it evaluates monetary policy. Thank you to the Federal Reserve Bank of Atlanta. Data as of May. So, what's ahead for short-term interest rates? Well, the Federal Open Market Committee has the following meetings scheduled. So, July 28th to 29th, that's the end of this month, September 15th to 16th, October 27th through the 28th, and December 8th and 9th. So, that's what they're going to be talking about over the next few meetings. And we'll see which direction the Fed goes with interest rates. So far, I don't think they're going to be lowering rates anytime soon. Here's another relationship to understand: bond market dynamics. Bond prices and bond yields have an inverse relationship. In other words, when bond yields go up, existing bond prices generally go down and vice versa. After experiencing years of low interest rates, some investors may be surprised to realize their bonds can lose money if sold before they reach maturity. Bond values may decline during periods of rising interest rates, but a changing tide in the economy doesn't mean that you have to abandon a fixed income allocation. Often, this movement is an important part of a well-balanced, diversified portfolio that may provide investors with the income that they need. However, keep in mind there's no guarantee a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification is an approach to help portfolio managers manage risk. It does not eliminate the risk of loss if a security price declines. So it's important we understand the relationship between bonds and rising interest rates and falling interest rates. So stay focused on the fundamentals. That's my advice. Tuning out headline noise while managing your finances is not always easy. However, wise investing involves more than reacting to headlines that may discuss consumer sentiment or geopolitical developments. For investing opportunities, one approach is to stay focused on the fundamentals, like a company's earnings or economic data, or maybe chart patterns. All right, bull and bear market trends. We've gone over a lot, but I'd like to conclude with a longer-term perspective on the financial markets. Having this perspective, I think, is key when pursuing the financial goals we've set up for ourselves. There has been a lot of volatility and uncertainty this year, but despite a rough first quarter, stock prices have recovered and diplomatic efforts continue in the Middle East. All three major market averages are up considerably for the second quarter, with the S&P 500 and NASDAQ composite, the tech-heavy index, posting strong double-digit gains. So the chart I'll put out here shows the daily historical performance of the S&P 500 index throughout U.S. bull and bear markets from the late 1960s through the first quarter of 2026. As we can see, when you look at it, the market's expansions and recessions over 84 years can help put things in perspective. The rewards of growing an innovative economy often go to investors with the discipline to remain invested over the long term, and knowing when to look past market noise in order to remain focused on the long-term goals is key. Remember, investing involves risks, and investment decisions should be based on your own goals, your time horizon, and risk tolerance for risk. Thank you, FT Portfolios 2026 for that particular chart. I'll put this out on the blog here in the coming week, but this is the lead podcast that talks about it, and you can reference it once you see the slide deck and the email that's going to go out in the coming week, or maybe by the end of this week. I hope you guys found this all informative, and thank you for tuning in to the Northbound Wealth Podcast. This is your host, Brent Foster. I enjoyed talking with you. Like and subscribe, follow us, and we'll have more information for you next week. Have a great week and weekend. Enjoy that hot weather out there in this summer. Take care.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.